Good afternoon, everyone. In this week's review of markets, we're going to ask ourselves the simple question: does the UK jobs data trump inflation? Quite simply, the UK market appears to be slowing faster in economic terms than other peer economies, and so I'm delighted to be joined by Matt Henderson, my colleague in the investment desk today, to look further into the UK. But first of all, Matt, let's start with the optimistic outlook, which is all-time highs in a number of equity markets this week.
Yeah, so I guess what we find interesting as an investment team is we're not actually seeing that many headlines about it. Other, events that dominated like Trump, inflation, central banks, etc. But I think we've had new highs in here, the UK FTSE 100. We've seen that benefit from how energy prices have moved recently, but then also the weakness that we've seen in sterling has really been a positive for companies in the FTSE 100 because of that translation effect from overseas earnings back into the FTSE.
And the main sector that would be driving that in the UK, because we obviously don't have a big tech sector in our stock markets. What was driving that here in the UK?
Yeah, so it's more come from the energy sector where we've seen oil prices pick up. But it's not just isolated to the UK, this effect. We've seen it in Europe. Germany's done the same. Italy's done the same. But also we've seen it in the US with more euphoria around Trump coming back in as president.
So we're reading plenty about Donald Trump in the front page of the FT. We're not reading anything about a new high in the UK stock market.
Yep.
Is it all to do with Trump, or is there something perhaps broader affecting equity markets?
No, it's not just all Trump. Obviously, some of it will be attributed to that. But when we're looking at the data and the information that we can see, when we look at things like earnings revisions, so how analysts expect earnings to move, are they moving higher or are they dropping down and moving lower? We're actually seeing positive momentum in that. So analysts are actually thinking, do you know what? These companies can actually deliver more earnings than what we originally expected. So it's more actually being driven by the earnings side of things rather than just Trump himself.
So that's a great start. So really the global outlook for the Western stock markets is that this latest leg of the rally has been driven by an improved outlook for earnings, which is great for future profitability of firms. So let's now, as promised, focus in on the UK.
Yep.
We had the jobs data this week. I guess the main headline to fall out from that is that we're now expecting an interest rate cut from the Bank of England next month.
Yeah, and that's really just due to the data that we've seen, although it's not as clear as a path as it might have been otherwise for the Bank of England. So as you mentioned, with the labour data that we've had, it's actually been more negative. So we've seen the unemployment rate tick up. And what we'd seen previously is actually within, the components that build up the unemployment rate, it had been those who weren't actually seeking labour. That was what was driving unemployment higher. Whereas now what we're actually seeing is that change where it's actually firms reducing headcount, which is driving unemployment higher. So it's a subtle difference, but it's moving.
So this is the difference really that sets the UK apart, isn't it? That the unemployment rate rose in the US last year, but that was simply because more people entered the workforce than could find work.
Yeah.
So the unemployment rate, which is just a sort of a relative measure, went up.
Yeah.
So jobs growth month on month remains strong. What we're now seeing here in the UK is that definitely towards the end of the year, a real pullback from British businesses with hiring. And then more than that, there actually looks like they're shedding jobs.
Yeah, and most of it's come after some of the budget stuff that we'd seen.
And that's a difficult thing, I think, for politicians to have to deal with, is that it does look like there was a turning point shortly after the budget. If we look at the payrolls data from HMRC rather than the labour force survey, which is subject to some measurement difficulties. So something to keep an eye on. We are seeing weakness in the labour force data, and it's come through in the unemployment rate, as you said. Wages, though, were actually very strong still.
Yeah, so they've remained sticky. They're about 5%, call it. So this is why it doesn't become the easiest of decisions for the Bank of England to make, because although you're wanting to reduce interest rates to support growth, looking at what's happened with unemployment, the fact that wages are remaining sticky actually risks, if we do cut rates, do we see price inflation increase off the back of it? So it's a balancing act, measuring up those two risks and, seeing which one takes priority for the bank. And
I guess the real conundrum is that, as you say, with wages in real terms relatively high, real wage growth somewhere between 2.5%. It's not being felt on the high street. Retail sales numbers for December were poor, so this probably does add more to the Bank of England's case for reducing rates at the next meeting.
Yeah.
One other data print that came out which should worry the Treasury is borrowing numbers were much higher than expected for December. So again, probably feeds into the narrative that the underlying economy here is weakening quite quickly.
Yeah, and it's a theme that we're seeing across all other regions as well, where governments are borrowing more and spending more.
In Europe,
yeah.
Whereas the US obviously continues to be very strong,
Yeah.
still borrowing large amounts of money, but they're getting more incremental value add.
Yeah, because the GDP story is stronger
Absolutely.
over there.
So, really delving into the UK then, we appear to have what we would describe as stagflation. So why don't we help our viewers understand what that term means?
Yeah, so stagflation is an economic scenario where GDP growth is quite slow, quite small, and inflation actually remains high and sticky. So it's kind of like a worst case scenario for a central bank because, if you try to support the growth side, you risk pushing up the inflation component. And if you try to tackle
Absolutely.
the inflation component, it's a risk to the GDP.
That's the risk, isn't it? Because the Bank of England in their last forecast already revised up the inflation outlook following the budget. They revised up their growth outlook, but that looks to be too optimistic. The challenge is they're probably going to be forced to cut rates to a moderate extent over the next 6 to 12 months whilst trying to push back on rising inflation, and that's going to be difficult. So we've got stagnant growth, we have persistent inflation, and that really is what gives us stagflation.
Yeah.
The path for inflation from here is higher. Do we have some sort of feel for where that might peak out this year? If the starting point is 2.5, Bank of England think it might just go below 3. Where would you put your money if you think it goes a bit higher than that? We're not going back to where we were.
No, I don't think we're going to reach those peaks that we hit in 2022 again, which I guess, limits some of the damage that could happen for the GDP side of things, so the bank don't have to really push out interest rates as high as they did, or we don't have to go through that scale and pace of interest rate hikes. But, the other dynamic that they're fighting against is weaker sterling that we touched upon earlier, where goods that they're importing as well. So they'll want to increase interest rates to shore up the currency to try and stop import inflation as well.
So that's the challenge, isn't it? That actually most of these issues we've discussed today are global challenges, which is inflation is sticky and persistent in the US, in the EU and the UK.
Yep.
We know that most governments are borrowing more than they perhaps should, given where employment levels are. The one issue for the UK, which is unique, is that we appear to be having a decelerating economy and that jobs growth appears to be turning negative, if we believe the HMRC data, which we probably should place more weight on. So, a summary there for where we think the UK is. So from a market perspective, it's very strong. All-time highs in equities, including the UK, as Matt has indicated. Bond yields now are back to where they were at the start of the year. So that means that bond indices have actually given a positive return this year as well. So positive returns year to date from global equities and global bonds. But this is also the challenge that sometimes the equity market doesn't reflect the underlying economy. And that's what Matt, I think, has presented here, which is a weak UK economy, but a very buoyant stock market. So we hope that's helped describe some of the issues which have perhaps gone to the latter pages of the FT when they really should have been at the front. But we hope that's helped you understand the UK in the context of Donald Trump, but he doesn't have control over everything. So that's all for today. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.